You're making this way too hard. RSI, MACD, Bollinger Bands, Stochastic, Fibonacci, Ichimoku. You know what all of these have in common? They're all telling you the same thing, and you're still losing. This trader is using two lines. That's it. Two lines, and a rule set so simple it fits on a post-it note. Here's the part that should make you uncomfortable. The reason you're losing in Forex isn't because your strategy is too simple. It's because it's too complicated. And complicated creates hesitation. And hesitation creates mistakes. And mistakes drain accounts. I'm going to show you the exact framework that fixes this. But first, I need to show you the one market condition where even this strategy, and the clean, simple one, will absolutely wreck you. Most educators skip this part. I'm not going to. Quick, before I explain anything, I want you to think about the last trade you lost. Was it because you didn't have enough indicators? No, it wasn't. Here's what the data actually says. Brokers across the EU and US, by law, have to publish the percentage of retail traders losing money on their platform. Go check any major Forex broker right now. The number sits between 70 and 82%. 70 to 82%. That's not a bad luck problem. That's a structural problem. And it comes down to three mistakes, the same three mistakes, showing up over and over again across millions of accounts. Mistake 1, trading against the trend. Seeing a pair that's been falling for 3 days and thinking, it has to bounce. That's not analysis, that's hope. Mistake 2, no defined risk. Entering a trade with no clear answer to the question, at exactly what price am I wrong? Without that answer, you're not trading. You're gambling with extra steps. Mistake 3, overtrading. Too many charts, too many time frames, too many signals pointing in different directions. You end up either paralyzed or worse, you just start clicking buttons. The 9 and 20 EMA strategy solves all three, directly. Let me show you how. 2 lines. What they're actually measuring. I know what you're thinking. Moving averages, really? That's your big secret? Yeah, and here's why that reaction is exactly the problem. Most traders dismiss simple tools because simple doesn't feel like an edge. But ask yourself this. When's the last time your complicated setup made you money consistently? Not once. Consistently. Simple isn't naive. Simple is executable. And executable is the only thing that actually makes money. So, what are these 2 lines? An EMA, exponential moving average, tracks the average price over a set number of candles. But unlike a basic moving average, it puts more weight on recent candles. That means it reacts faster. In a market that moves as quickly as Forex, that responsiveness is the difference between getting in at value and chasing price. I use 2. The 9 EMA, short-term pulse. What is the market doing right now? The 20 EMA, medium-term direction. Where has the market been trending? They answer the only question that matters before any trade. Which direction is this market moving in? And am I trading with it or against it? Here's the rule, and it is this simple. 9 EMA above 20 EMA, price above both. Market is bullish. You only look for buy setups, that's it. You don't look at short trades. You don't entertain what if it reverses. Bullish bias, long setups only. 9 EMA below 20 EMA, price below both. Market is bearish, short setups only, end of discussion. You just solved mistake number 1 from the stat I showed you, without a single other indicator, just by knowing which line is on top. Now here's where most people blow it, and this is important, so stay with me. They see the 9 cross above the 20, what we call a crossover, and they buy right on that candle, immediately. And then price pulls back, as it almost always does after a crossover, and they get stopped out. And then they say, moving averages don't work. Moving averages work fine. The entry was just wrong. The crossover is not the entry. The crossover is the alarm going off. The entry comes after something very specific, and I'll show you exactly what that is right now. The setup, the entry, the rule. I'm going to give you this in 5 steps. No filler, no padding. Write these down. Step 1, direction filter. Before you open a single position, look at the 9 and 20 EMA. 9 above 20, bullish. Long trades only. 9 below 20, bearish. Short trades only. If you can't immediately tell which one is on top, the market is sideways. You do nothing. We'll come back to this. Step 2. Wait for the crossover. You're watching for the moment the 9 EMA crosses through the 20. In a bullish setup, 9 crosses up through 20. In a bearish setup, 9 crosses down through 20. This is your alert, your starting gun. You are now in active watch mode. You are not in trade mode yet. Step 3. The pullback. This is where the edge lives. After the crossover, price will push. Sometimes hard, ignore it. Do not chase. Let price come back to you. What you're waiting for is price to retrace back toward the 9 and 20 EMA zone. Think of the EMA zone as a magnet. Price almost always comes back to test it after a move. That pullback is where amateur traders got stopped out buying the breakout. It's also exactly where you're going to build your position. Step 4. The confirmation candle. Think of the EMA zone as a floor. You need to see price touch the floor and bounce. What does that look like? A candle that tests down into the EMA zone and then closes back up above it with conviction. A strong bullish close. A hammer. A bullish engulfing. The market is showing you buyers are defending this level. The trend is still valid. The pullback was just a breath, not a reversal. That candle, that is your entry signal? Step 5, entry, stop, target. Entry, close of the confirmation candle, or open of the very next candle. Stop loss, below the swing low that tested the EMA zone, that wick. That's the line, price goes below it. The setup is invalid. You're out, no negotiation, no let me give it more room. Out. Target, minimum 1-2 risk to reward. Stop is 20 pips, target is 40. I personally aim for 1-3 on clean setups. That's the whole strategy. 5 steps, post-it note. And here's what's wild. You just solved all 3 of the mistakes from the stat. Direction filter solves trading against the trend. Defined stop solves undefined risk. Waiting for the pullback solves overtrading random entries. 1 strategy. 3 problems fixed. Now, the setup killer. What destroys this strategy? Okay, I have to be honest with you about something. This strategy will lose trades. I'm not going to pretend otherwise. But there's one specific condition where it doesn't just lose. It produces false signal after false signal and absolutely drains accounts if you're not watching for it. Here it is, ranging markets. When price is chopping sideways, bouncing between a ceiling and a floor with no clear direction, the 9 and 20 EMA start doing something very specific. They flatten out. They start crossing each other repeatedly. Every few candles, crossover up, crossover down, crossover up again. Each one looks like a signal. None of them are. This is where traders get chopped alive, taking trade after trade, each one looking like the setup, none of them following through. So, how do you spot a range before it costs you? 2 things to look for. 1, are the EMAs flat and tangled? If the 9 and 20 are running roughly horizontal and keep crossing each other, range. Do not trade. 2, is price respecting a clear ceiling and floor? If you can draw a box around the last 20 to 30 candles and most of the price action fits inside it, range. Do not trade. The strategy only works in trending markets. Your first job, before you even look for a crossover, is to confirm the market is actually moving in a direction. Most traders see a ranging market and feel like they're missing out. Flip that. Recognizing a range and doing nothing is one of the highest skill moves in Forex. The market that isn't set up is not your market. Leave it. What this does to you over time. Here's something nobody in trading education talks about. Simple strategies don't just improve your results, they change who you are as a trader. When your system has clear rules, this is the trend, this is the entry, this is the stop, this is the target, something shifts. You stop white-knuckling every candle. You stop refreshing your phone every 3 minutes. You stop revenge trading after a loss. Because the enemy in trading was never the market. The enemy was uncertainty. And uncertainty is what complicated systems create. Clear rules remove uncertainty. Removed uncertainty removes emotion. Removed emotion removes the mistakes that were compounding your losses in the first place. On time frames, I run this on the 1-hour chart for Forex. Here's why. On a 5-minute chart, you have nearly 300 candles during a London and New York session combined. That's 300 decisions, 300 chances to second guess yourself. On a 1-hour chart during those same sessions, you're watching 13 candles, you're patient, you're selective. You're waiting for the setup, not manufacturing one out of noise. Higher time frame, fewer signals, higher quality signals. Before you trade this live, here's your exact progression. Step 1, backtest. Pull up EAR USD or GBP USD on the 1-hour chart. Go back 6 months. Identify every crossover, every pullback, every entry signal. Track the outcome. Do this for a minimum of 50 setups. Step 2, paper trade. Run the strategy live on a demo account for 2 to 4 weeks. No real money, just execution reps. Step 3, go live small. Start with minimal position size. Scale up only as your results and your confidence justify it. That's not the slow path, that is the path. The traders skipping these steps are the ones contributing to that 70 to 82% stat. Remember that chart I showed you at the start? 14 indicators, dozens of conflicting signals. That's not a trading system. That's noise with extra steps. 90% of Forex traders lose because they trade against the trend. They don't define their risk. And they overtrade whatever looks like a signal. 2 lines fix all 3. A direction filter, a pullback entry, a defined stop. That's the whole system. It won't win every trade, nothing does, but it gives you a real, repeatable edge and compound it over weeks and months. That's how accounts grow. If this changed how you think about your charts, subscribe. I'm going deep on price action next, and it stacks directly on top of everything I just showed you.